Welcome back to the new video. So today we are going to analyze this company called Prospect Capital Corporation with the stock ticker PSEC. And as always, we are going to analyze this stock using this Excel table that I prepared, especially this checklist where we are going to decide whether we should buy or sell the stock according to the data that we see here, okay? And we will always keep the following 3 rules in our mind, which is analyze the last 10 years, decide whether we should buy or sell the stock, and start with analyzing good things, then bad things, and at the end we will have a final call whether we should buy or sell this stock. It's very simple, okay? And as you know, we will start with the good things, and there are unfortunately very few of them. So in the income statement you can see that only the good thing is that gross profit margin is always above 40%, which is what we want to see, okay? And then in the balance sheet, you can see that there is absolutely nothing good, unfortunately. And then we come to the cash flow statement, and here you can see that P/E ratio is lower than the P/E ratio from the competitors, okay? So here those 8 numbers are the P/E ratios of top 8 competitors from this company, okay? And their average is 22. Whereas the P/E ratio for this company, so PSEC, is 3, which is both lower than 15, what we want to see, and also lower than P/E ratio from the competitors. So P/E ratio, basically means that for each €1 profit, you have to invest €3 in this case, okay? So for example, in competitors, on average, if you want to see €1 profit, you should invest €22. And another good thing is intrinsic value. So intrinsic value is actually the fair price of this stock. This tells us what the price should be right now to have it like a fair valuation, okay? And you can see that the intrinsic value should be around $6, whereas the current price is around $5, which means that intrinsic value is €1 higher and $1 higher. That means that the stock is, according to complicated calculation behind intrinsic value, $1 undervalued, okay, which is a good sign. And now we come to the bad things. So grab some popcorn because there are going to be quite a lot of them, okay? And the first thing, that you can notice, for example, from these charts here, is that financials are extremely unstable, okay? Take a look at total revenue, for example. Take a look at gross profit. Take a look at income statement, operating income, net income margin. Everything is like growing a bit, then falling, and then growing again. Everything is so unclear, so wavy, so to say, And we as investors, we don't want to see that. We don't want to see unpredictable growth, okay? Because we want to see something that we can easier predict in the future. And you can also see, that net income in 2020 and 2023 is even negative. Just like net income margin, preferably we want to have it always above 20%. And you can see that there are years where it's extremely good, for example, 2021, maybe 2018 and so on. But there are also years where the net income margin is lower than 20 or even negative, And we don't want to see that at all, okay? Then we come to the balance sheet, and here in the balance sheet, the first thing that you will notice is that retained earnings are completely horrible, okay? So what do retained earnings actually mean? So this means that how much money company reinvests back into itself instead of paying it as dividends to the shareholders, okay? And here you can see, if it's negative, that means that they are paying way more dividends than they can currently afford. And that's very unsustainable business model on the long term, because at some point, they will for sure run out of cash. And you can also see, for example, here in income statement, those years here in the middle from 2017 to 2021, they are all having lower total revenue, gross profit. They have lower financials here. Because of that, you can see that this is kind of connected with each other. Here they have way too big negative rated earnings, which means that here actually in those years they were taking money from those years here, which is completely bad because they still wanted to pay the shareholders, and that's unsustainable in the long term. And then you can see that return on equity is kinda okay, preferably we want to have it over 10%, and here is kinda getting closer of some years, but in the last few years it's completely horrible, bro. It's negative, which we don't want to see, because that means that the company is making loss instead of profit, and this is, as I said, unsustainable, okay? Another bad thing is that total liabilities are growing through the years, and also debt to equity is also relatively high. You can see that preferably we want to have it lower than 50%, or at least lower than 60%, but right now it's around 70%, and this is actually the lowest that it was you can see here 57%, which is okay, but also bad at the same time. You know what I mean? It's meh, And dividends, bro, here when we go to cash flow statement, you can see that the dividends are, for us dividend investors, very important. And you can see that the dividends, not only are they the same for the last few years, they even fell from 2024 up until now, which is an extremely bad sign, because we want to see dividends growing through the whole years and not the opposite, okay? So now we come to the checklist, and we can see based on that whether we should buy or sell this stock of Prospect Capital Corporation, okay? So let's go through it. Is company growing? Yes, based on our graphs it's growing, but it has still a lot of uncertainty, so we will mark that as a no, okay? Because we want to be as harsh as possible when we evaluate this company, okay, or all the other companies overall. So are margins above preferable? Let's see. So here 40, it's okay, it's above 40, and here it's below 20. Then here right now it's below 10, here it's more than 50, so no, the margins are not preferable, because yeah, you see. Is debt decreasing? No, it's not, it's staying the same, so here is also no. Is company reinvesting? Unfortunately not, quite the opposite. As you can see here, they are paying way too much cash to shareholders instead of reinvesting it back, so that's a no as well. Are dividends growing? No, because you can see that here they are always the same, and they even fell. Is P2E below competition and 15? Yes, it's currently 3, so it's below 15 and below 22, so that's the first good sign finally. Is price undervalued based on intrinsic value? Yes, it is, because based on intrinsic value it should be around $6 to $7, okay? So here we can put yes. And the final question, is price less than 150 euros? Yes, it is, because currently it's trading at $5.5, okay, so yes. And as you can see, according to the checklist, we should not buy this stock. And I agree with that, because bro, even though the company is slowly growing back, as you can see here in the charts, it has way too inconsistent financials from previous years, for example from 2017 to 2021, and we don't want to see that. And the biggest red flag that I can see right now is retained earnings report, okay? The retained earnings are way too shitty. They are investing way too money. They are paying way too much money back to shareholders instead of reinvesting it, and this is completely unsustainable business model, okay? And of course, for us as dividend investors, it's very important that we see dividends growing and not falling. So this is of course another bad sign, okay? And here the difference between intrinsic value and current price is way too lower to be able to even speculate on this stock. We cannot even speculate to maybe buy this and then sell it maybe 1 year afterwards, because it's way too low. Like the difference here in intrinsic value is way too short, and we don't want to see that, okay? So bro, now you know what to do. Do the hard work, and we see each other on the top of the world.